This is Sandeep Anand. Welcome to Sand Compounding. Let me take you to the world of investing in China and introduce you to a great fund manager and investor. His name is Lilu. He runs Himalaya Capital. He is a founder since 1997. He has been running Himalaya Capital for 21 years and been quite successful in doing that. And he is a Columbia School alumni and a staunch value investing follower of Benjamin Graham principles. He has managed Charlie Munger's funds for 15 years or so now and has been quite successful in doing that. Lilu has also authored a couple of books and he has seen through the transformational rise of China to the superpower. Now take a look at few investing principles from Lilu in this video.
The first one is the stock is not a piece of paper that you trade, but is a representative fractional ownership of a company. And therefore, valuing the stock ought to really have a basic bearings of valuing the company as a whole. And then secondly, that in valuing any financial asset, that you have to really predict the future, the discounted cash flow of the future cash earnings. And the future is inherently difficult to predict. And therefore, you really want to leave yourself a margin of safety so that you could be wrong or you could be right. But because the future is a distribution of opportunity, of statistic possibilities. Say you bet on something that at 90% of the chances you could be right, but then a 10% chance occurred, and so all of a sudden it become 100%. So you want to leave enough of margin of safety. In other words, you want to buy at a low enough of a price, even if all the adverse events occurred against you in the future, you will still be in the game. It doesn't mean you won't lose money, but it just means that you will not lose so much that you'll be out of the game. Because investing is really a long game. It can play over the life of anybody's career. And so you want to be really in the game somehow over the long haul. And the third concept is Mr. Market, to figure out a frame of mind to think that when the market is against you, you can really look at it as a neurotic Mr. Market that's prone for emotional and irrational behaviors. So those are the three basic concepts. At the heart of it is obviously it is this bargain idea that you want to really get what you pay for. In value investing, you have to have this frame of mind that if you did your work correctly and the market against you, you should be comfortable standing alone. And this is the concept behind Mr. Market. But that's really very difficult to do. Indeed, it is a very unnatural thing to do. When the whole market is against you, when everybody else really think you're stupid and neurotic and wrong, and you now tend to think everybody else is a Mr. Market, irrational, neurotic, that is very, very unnatural things to do towards the borderlines of a self-delusion. Indeed, that's probably most people's view about you at the time. You look quite ridiculous and very uncomfortable. In fact, our very evolution requires a certain deal of conformity. Think about over the millenniums, over the millions of years of evolutionary past. Our ancestors, our animal predecessors, basically hunting groups. And if one was left out and disagree with everybody else in the group, very easily that one is not the one to survive. So all the genes that have survived in the past are the ones that tend to an extreme degree of conformity. And conformity also works very well as for human society, because we are at the end, at the heart, as social animals. We need that sense of glue of a conformity and sympathy, compassion to bring the society in peace and live together. So you need a certain mutated genes, in a sense, to be utterly comfortable to stand alone when everybody else disagree with you. have to, my whole point is you don't have to swing a lot. One of the key of a success for being a long-term successful investor is you have to endure a long period of time in which you do nothing. You don't have to do a lot in order to be fabulously rich and prosperous. That's the good thing about this game. You study all the time, but you don't have to do anything. And every time you do, when you don't have enough margin of safety, you can come out really losing. And that's really much worse than really than doing nothing. But every time you do something, if you have large enough of margin of safety, your upside is also becoming huge. And there are many, many examples, and I wouldn't have time to go into it, and in which when you turn out to be right, the upside is just enormous. You could really surprise your wildest dreams. And you want to wait for those fat pitches. I find, as I look at my own career, of all the ideas that I find, they really tend to come from all sources. I don't have a particular rule where they come from. If you have a curious mind, if you study all the time, and you maintain a good network of relationship with other smart, intelligent investors, they have a way of really looking into what they do, you tend to find a lot of a source of interesting ideas. And in today's age, because this regulatory requirement was disclosure, I wouldn't be surprised you can really find a lot of great ideas just out of reading publicly available information. It is judging what is a good opportunity that is really difficult. Well, you always have to have some kind of a diversification. Because A, you could be wrong, and B, even if you're right, you're betting on statistics. In other words, the future is essentially a distribution of all probabilities. Say you have a 90% conviction, and you're right, that event is 90%, but then 10% chance it happened. And so you don't want to that 10% to get you out of the game. So you do need to diversification. On the other hand, that recognizing is extremely rare to find no-brainer great opportunities. Extremely rare. In fact, you have to wait for a long time before the fat pitch to come to you. So when that happens, you certainly do not want to diversify away the opportunity that you have been waiting patiently for a long time to discover for some really inferior other opportunities. So investment is essentially the opportunity cost. So one other alternative have to really justify itself by comparing with the one you already have. And so when you make that comparison, you tend not to really diversify too much. You would find a few very, very good ones that have a very high conviction and let it rise. And so yes, you do a little bit of both.